Hi, Neelam. Thank you so much for joining me. Today, we are going to be discussing something that I think is the bedrock of our operations, our pricing methodology, and how we handle liquidity. So I thought, as a first question, if you could maybe just quickly explain what it means to be a non-DMA platform, and why has EasyEquities gone with this specific approach?
Cool. Thank you, V. Thanks for the opportunity. And yeah, you're 100% right. This actually does form the very basic or basis, of investing. You have to understand this concept. So DMA actually stands for direct market access. And what that simply means is that if you're using a DMA platform, it is plugged or routed directly to the exchange. So your executions go straight through a broker directly onto let's just assume it's JSE,
Okay.
and you're talking about the South African market. So a transaction happens directly on the JSE. The first thing about a DMA platform is obviously it comes at a cost.
Okay.
Right? So you've got to pay for the actual privilege of having that connectivity directly to the exchange. The second thing with that is that you're subject to the liquidity available to everybody on the exchange. So let's say there's only 500 shares on offer, and I know we're going to get into a bit of detail as we chat about that, but let's just assume that somebody's selling 500 shares. If you have 10 people looking to buy 500, one of them is going to get the 500.
Yes.
Right?
Okay.
So you're subject to that. So you're subject to underlying liquidity. And then there's also certain types of regulations that one has to have, or certification that one has to have to allow them to be able to trade, because you're trading on a public environment, that's subject to a whole lot of regulations in terms of lots of things, price manipulation, insider trading, and all those good things, which we're not going to complicate. So, that's a DMA platform. That's essentially, what it stands for and what it is. Why have we chosen not to go that route? Firstly, because the architecture and the technology for it is complex and it's expensive.
Okay.
And as you know, we're all about saving costs and bringing the most efficient way to invest to our customers, right? So any way that we can bring down costs would assist. Now, do customers get a different experience slightly? Is it to their disadvantage? No, it's actually to their advantage, because those 10 customers that I spoke about trying to buy
Mm-hmm.
the one lot of 500, in our world, potentially all 10 could get the 500. And then we would go and look and work that order to go and buy the 5,000 shares that effectively we need.
Okay.
Okay, so it works
Okay.
slightly differently. So this is our fundamental differences. The point is one of efficiency, and obviously costing.
Yeah.
It's a much cheaper solution and journey for the customer, and efficiency obviously, because all those costs ultimately relate to returns over time. So the lower that we can keep costs, naturally to the benefit of
Better.
the customers. Yeah.
Okay. So would you say it's like if you had to go to one of those farmers markets, somebody selling carrots and onions and cows and pigs and chickens, instead of having to go to like each stall and kind of like negotiate and deal there, would you say it's kind of like are we a little negotiator that kind of works behind the scenes, finding those best prices and matching things together?
So no, not matching things together. We're still reliant on the pricing of the underlying exchange, right?
Okay. That's
So when
important.
you look, yeah, so when you look at the structure of the market, there are sellers in the market which are on the offered side or the
Hmm.
ask side of the market of a price, and there are buyers which are on the bid side, right? And those
Okay.
two prices obviously move around as supply and demand, changes in the market. When a trade happens, it simply means that a seller is prepared to sell to a buyer, or a buyer is prepared to buy from a seller. That's
Hmm.
when an actual transaction happens. What we reference in terms of where we fill customers is the best offer. So when they're buying, the lowest offer price, so the most advantageous price to the buyer on our side.
Okay.
Or if our customers are selling, they'll get the highest possible price on the exchange. So
Okay.
in both instances, we reference what you call the best bid or ask price. In other words, the highest bid or the lowest offer. And that's
Okay.
where that's the price that our clients actually receive in their orders, is best bid, market bid and offer. And that price
Okay.
is available to everybody on the exchange, right?
Okay, which dovetails nicely into my next question. So oftentimes the price that clients see on the trade ticket, when you want to buy the shares, the price that you see, sometimes it differs from the actual price that goes through once you've placed the trade. So why are our prices delayed? And, is this, just why do we have delayed prices?
Sure. So part of the construct of the market, the JSE operates on the basis that if you have access to live pricing, live meaning constantly rolling, active pricing, if you have access to it, you need to pay them a fee for it. So you could have access and never use it. Let's say you're traveling for December. Let's say you're shutting down today and you cruising around the country or the world for the next 30 days,
Yeah.
from all the dividends you've made, obviously investing, um, and you never sign onto your platform for the whole of December. The fact that you have access means you still have to pay, and we fundamentally disagree with that, right?
Mm,
Because and the cost. I mean, some people may argue that 100 rand or 110 rand or 120 rand for live data is not a lot of money. But take the investor, take the retail investor that's only able to invest 500 rand a month. That's 20% of his savings gone to something that he might potentially use once or twice or 5 times a month. Who knows?
yeah.
Maybe
Yeah.
even if it's every day, but maybe not. Um, does it warrant a 20% expense? And so anything less than 15 minutes delayed is considered live. So if we delayed it by 10 minutes, we would still have to pay that fee.
Oh, wow.
So different exchanges have different structures, obviously. The most common one is 15 minutes, which is why we've delayed by 15 minutes. It's to avoid that fee. Although you see a 15-minute delayed price, when you execute, you're actually executing. Remember, I was talking about in the previous
Mm,
question, the best bid and ask price?
yes.
You execute at the live underlying best bid or best offer price on the JSE. So,
Okay.
if you call up a DMA platform and if you look at the platform that or pricing source that has live prices and you execute at that time and you look at the price, that's the price you'll get. Although you're seeing on EasyEquities, you'll see a 15-minute delayed price, you will be
Hmm.
filled at the live underlying price. And so it is
Okay.
largely just to save that fee.
Okay. But now, I mean, let's say we're dealing with a share that's there's some movement around it, and I want to know exactly what I'm going to be paying for. Is there a way that I can see the live price should I choose? And if so, how does it compare cost-wise to, live access all the time?
Sure. So this is something that we've addressed, and we found a solution in a almost a click to view structure for pricing. So we're
Okay.
saying, hang on, I have an issue with you paying for something that you might not use. I have an issue for you. I have an issue with customers paying for something that, or the same price for something they might use once a month versus 1,000 times a month. That, it really doesn't gel well with us, specifically for the business that we're in and our customer base specifically, right? So what has transpired on the back of those discussions is a pay-per-view structure, which we've now incorporated. Well, not now, but we have incorporated in EasyEquities. We had it for a while now, where you literally can go and click on a button to view a live price at that moment of execution. So to your point, the share is volatile and it's been swinging around the whole day, and you worried that you might see a price of 10 rand, but when you get filled, it might be at 12 rand, and you want to avoid that. Just bear in mind, it could be the other way as well, right? You could see 10 rand and buy it at 8 rand. That's also possible, right?
Yeah.
And that does happen, contrary to popular belief. But let's just assume the 10 to 12 move, and you're trying to avoid that. There is a button where you pay literally 25 cents, and we collect all that data and then we submit it and report it to the exchange, and we obviously pay the exchange on that click per view basis. So
Okay.
you have that ability to actually remove that uncertainty, view a price. If the price suits, execute at that moment, and then the likelihood, that differential we call slippage. That's the word that's used.
Okay.
That's the terminology. It's called slippage, where you see a price of 10 rand and you get filled at 12. So it minimizes that slippage.
Okay. Okay. So like a little snapshot of the price. I think I will link an FAQ below on how you guys can access it. That's amazing. I think we've covered pricing quite nicely. So let's move on to liquidity. I mean, liquidity investing, those you're always going to hear about liquidity, but I think it might still be a bit of can still be a bit of a confusing topic for some of our clients. So if you could maybe just briefly explain what liquidity is and why it matters when you're placing trades and investing.
Sure. Yeah, this is, it's all related. We spoke about the bid-ask price earlier. Um, that's a manifestation of liquidity.
Okay.
Liquidity at a high level literally just describes the ease at which you can get in and out of something.
Okay.
So, or buy or sell something. Let's consider a house, right? I mean, it's unlikely that you could buy a house today, take ownership in one day, and sell it tomorrow and relieve yourself of that ownership, right? So it's not the
Yeah.
most liquid, but you can do that with a share in minutes or seconds or some shares. And so, what liquidity, the terminology describes, is the ease at which you can invest into something and or buy something and sell something. So a very liquid stock means you can do that quite easily. A
Okay.
less liquid stock, an illiquid stock, means that, it might take time. How does that manifest in pricing? A very liquid stock, you can imagine lots of buyers and lots of sellers,
Hmm.
very, very close prices between the bid and ask. That difference between the
Okay.
bid and ask is called the spread, bid offer spread. Those spreads are very narrow and very tight in a liquid stock. So, you could buy something at, let's assume that there's huge volumes that goes through a stock and it's incredibly liquid. You could buy something at 10 Rand and possibly sell it at 9.99. There'll be a buyer waiting at 9.99, for example.
Okay.
In an illiquid stock, it manifests as a much wider spread, right? So sellers are at 10 Rand, buyers at 8 Rand only. And
Okay.
immediately, if you buy it at 10 Rand and you sell it, you're down 20%. That's how it manifests. And that's why liquidity is critically important. So customers should pay attention to the average kind of bid offer spread. That will give you your first sign as to whether or not it's liquid. There's another little trick that we have, because we are non-DMA platform, we have set certain limits on our platform. And those limits are actually very scientific. This might be another separate section that we want to do just on this, but just
Mm.
as a cursory discussion around the topic that we're on at the moment. Those limits are a function of the volatility and liquidity of a stock. So if you see that we're allowing you to buy a small amount of shares in one go, it should
Yes.
tell you that that stock is relatively illiquid. You look at liquid stocks like Naspers or the top 40 shares. I mean, you can buy, 400,000 or 500,000 rands worth of stocks in one go, and you could
Yeah.
do, you want a million rand worth of stocks, you just do two lots immediately. But you look at a stock, let's say, in sort of outside the top 40, let's say above the top 100, those limits will start reducing, and you might have to do 20 trades to get that done. And what that represents is that we need to have comfort that if you come on and buy 2 million rands of stock, we are able to go and buy 2 million rands just as easily in the market.
Yes.
So if we're allowing you to do it, it means it's fairly liquid and we are pretty confident we can go and get it. If we are if we express a lower limit on a stock, it simply means that we're probably worried about the liquidity of that stock and may have to work a little bit harder to go and buy the stock, hence lower limits. And that's the concept of liquidity. So you typically want to look, it's a bit of a throw up because you want to look at the more liquid stocks because that spread, the difference between the bid and the offer represents a cost to you, but it's only a cost if you're buying and selling all the time, right? If you're buying and
Hmm.
you're holding it and you're investing medium to long term, then it kind of evaporates. But some may argue that the best opportunities often lie in the more illiquid stocks as well. So you
Mm.
kind of want to balance that. But I mean, the concept around liquidity is important because if ever you need to, life does throw people lemons from time to time, and you need to cash out and you need to liquidate and you need to convert to cash, you certainly don't want to have to take a 20% knock to do that.
Yeah.
All right. So
Yeah.
that's when liquidity becomes an important concept.
Okay. Definitely. I did want to cover the transaction limits, so that's great. And I mean, obviously, these aren't arbitrary numbers that we just go, I think the share should be. We can only buy 1,000 shares. Is it? I mean, I'm guessing there's a
Yes.
process.
Yes, there's incredible, we have a fully fledged risk management team behind that. And the science behind that is basically we look at historical liquidity. In other words, what's the daily turnover of that share? How many shares have traded in that stock every day for the last 3 or 6 months? And then we look at the historical volatility of that share as well. So in other words, how much does the price fluctuate of that stock? So a highly volatile stock would demand a lower limit.
Hmm.
Um, a highly illiquid share, so a share that doesn't have liquidity will demand a lower limit, and then vice versa. And so we measure that matrix for every single stock that we have on the platform.
Okay.
So
And
it is quite
adjust as need be.
scientific. Yeah, exactly. And we review that monthly. So it is. And there are alternatives. So let's say
Yeah.
somebody's looking at a relatively illiquid stock and we saying, hang on, we only comfortable showing you 5,000 Rand per ticket or per execution, and you have to do 100,000 Rand. Now, do we expect you to go and do 20 transactions? No. You can always just contact the trading desk at easyequities.co.za, pop them an email with the relevant information, your account details, the stock, the price you want, and we can go and work that order for you. So we can go to the exchange and we can place that order, and as
Okay.
we get filled, you get filled, kind of thing. So there are alternatives to work around that. So but the point I suppose around liquidity, and perhaps the most important point, is that we all, the entire market and all our customers collectively, are funneling through one ultimate source of liquidity, which is the exchange. So everyone's looking at one price and one number of shares that's available, and you've got thousands of participants looking at that, right?
Oh, wow.
So
Yeah.
yeah, so please think about it that way the next time you want to know why you didn't get the price or why you didn't get full. That's the reality of it.
Okay. I mean, just a curious question I have from my side. So if we didn't have these limits, I mean, would there be a situation where somebody could say, I want 100,000 shares, but they're just not there?
Correct. Yeah. So they would. Yeah. Exactly. And what happens in the background is quite a process actually. So you log onto the platform, you buy your shares, right? There's an entire settlement process that needs to happen in the background. So we take the money from you, we reflect that trade in your account, but that trade now needs to settle. We need to pass that money on to from the person that we bought the shares from. Now, assuming we can't go and buy those shares, in in that settlement cycle, we need to now register those shares in your name, but we don't have them because the offer is not there. This is the science behind that limit.
Okay.
If we cannot get the shares, we unfortunately have to come to you. It doesn't happen often, but there are times where we have to come to you and say, hey, listen, the 100,000 that you bought, they just weren't there and we can't deliver the shares to you. We can't get them anywhere. So we're going to have to reverse that trade or cancel the trade and try and work in order for you to try and get them differently.
Oh, wow.
So that's infrequent, but it can happen. We
That's
have to be in a
possible.
position to buy the shares so that we can register you as the beneficial owner of those shares, because ultimately that's where it ends up through that settlement cycle, right? Your name is going to be attached to that shareholder register. That company is going to pull up the register and say, hey, V, you own X shares.
Yeah.
Mm.
That is fascinating. Wow. I think we've covered everything that I wanted to cover. So I think last thing, if there's one thing that clients should take away about how we manage our pricing and how we handle liquidity, what would that be?
Pay attention to the spread, right? Because the spread tells you a lot around the liquidity of the share. Um, don't assume that shares operate like ETFs. In the ETF world, there are mandated people or entities or businesses that whose sole purpose is actually to make you a market. They're called market makers for that reason. Funny that. Where they are on screen permanently in a certain number of shares and quantity, and that's their job, right? They get paid to do that. That's in the ETF world, which is why in terms of ETF liquidity, they can often outperform that of share liquidity. In shares, that concept doesn't happen, certainly not in SA. So pay attention to the bid offer spread. A wide bid offer spread is going to indicate an illiquid share, and you probably want to go in smaller tranches if that is the case. And naturally, a very tight spread or narrow bid offer spread will indicate a very liquid share. So there's a lot of that. And then also, if you want to do anything outside of the limits, or you want to do sort of trades, you don't necessarily have to frustrate yourself. You can contact us and we can assist you on the trading desk with that. There's a team of traders that will help you with that. So yeah, that's
Amazing.
what you
And
need to.
then live prices. Grab a snapshot if you want to confirm what you're going to be
Yeah,
paying.
absolutely. And you get to see that before you execute. So you can choose if the price doesn't suit, skip it and wait for the price update that you want. So yeah.
Amazing. Thank you so much. I really appreciate your time, Neelan, and we will do this again soon.
Absolute pleasure, V. Thank you very much.
Thanks, man. Bye.
Take care. Bye bye.